Let me start with a question that sounds simple, but once you really think about it, it becomes uncomfortable. If everything is fine, why does your money buy less every single year? Not sometimes. Not during crises. Every year. And if the system is so strong, why are the smartest institutions quietly preparing for something else? Because what I'm about to tell you isn't a theory. It's not speculation. It's not fear-mongering. It's what markets whisper, long before headlines scream. Most people think this metal's recent surge was just another commodities cycle, a hype phase, a speculative bubble. That's because they're looking at the wrong chart. This wasn't a trade. This was a signal, and history has never ignored signals like this. People assume prices move because of excitement, that investors suddenly liked something, that money flows because of trends. But markets don't work that way at the institutional level. Large capital doesn't chase excitement. It chases survival. When something historically volatile starts behaving like a safe haven, when it outperforms assets designed to protect wealth, when it quietly absorbs capital, while optimism dominates headlines, that's not speculation, that's positioning. Here's what made this moment dangerous. On the surface, everything looked normal. Employment strong, spending high, markets celebrating soft landings. People were told, this is stability, this is resilience, this is strength. But under the surface, something else was happening. A traditionally unstable asset didn't just rise, it repriced reality. While stocks struggled, while bonds quietly bled value, this metal didn't just outperform. It exposed something uncomfortable. The system itself was weakening. Politicians are constrained by elections. Central planners are constrained by narratives. Media is constrained by attention cycles. Markets are constrained by math. And math doesn't care about confidence speeches. When deficits grow faster than productivity, when interest costs grow faster than growth, when promises compound faster than real output, something has to give. And historically, it's never been the system admitting fault. It's always the currency absorbing the damage. Every dominant system follows the same arc. At first, borrowing fuels growth. Then borrowing sustains comfort. Eventually, borrowing delays consequences. The shift happens quietly. You don't feel collapse. You feel compression. Prices rise faster than wages. Assets inflate faster than savings. Risk increases while stability is advertised. And that's when protective capital moves first. Here's what most people miss. Gold is a reserve asset. It sits. This metal works. It flows through infrastructure, through energy systems, through medical technology, through communications, through electrification. When industrial demand meets monetary demand, you don't get speculation, you get scarcity. And scarcity is where truth surfaces. For years, demand has outpaced production. Not slightly. Structurally, mining hasn't kept up. Recycling hasn't filled the gap. Inventories have thinned. And when stress hits the system, lease rates explode. That's not retail behavior. That's institutional urgency. This has happened before. When empires diluted their currency to fund comfort. When leaders promised temporary solutions. When stability was maintained by confidence instead of discipline. Merchants noticed first. Markets reacted second. The public learned last. The names changed. The mechanics didn't. Money isn't backed by metal anymore. It's backed by belief. Belief in discipline. Belief in restraint. Belief in independence. When those pillars crack, currency doesn't collapse overnight. It decays. And decay is harder to detect than collapse. Most people think inflation is prices going up. That's not inflation. Inflation is time stealing value from stored effort. You worked, you saved, you deferred consumption, and over time, those stored hours buy less. That's not a market failure. That's a design consequence. Smart capital doesn't argue ideology. It spreads exposure. It reduces dependency. It avoids single-point failure. When everything you own depends on one system, staying perfect forever, that's not investing. That's faith. There's a difference most people never learn. Nominal assets promise future currency. Real assets exist independent of currency. When currency weakens, promises weaken with it. But real things adapt. Land, energy, infrastructure, productive enterprises, hard assets. They don't disappear when units change. You don't need collapse to lose purchasing power. You just need stagnation plus dilution. That's how middle classes shrink without riots. Quietly, legally, gradually, retirement numbers stay the same. Lifestyle expectations don't, and the gap becomes the shock. Every monetary transition punishes rigidity and rewards adaptability. Those who assume the future looks like the past lose leverage. Those who prepare for multiple outcomes survive, not by predicting, by positioning. Don't concentrate risk in one form. Don't store value in one promise. Don't depend on one system staying rational forever. Balance tangible with liquid. Productive with defensive. Local with global. Resilience beats optimization in unstable eras. The warning most people, this metal didn't rise because it changed. It rose because what it's measured against did. That distinction matters, because once credibility erodes, it rarely recovers quickly. Transitions accelerate, and those waiting for official confirmation always arrive late. History never announces turning points. It whispers. Through price behavior, through supply stress, through silent accumulation. By the time explanations become mainstream, the opportunity to prepare is gone. This moment isn't about fear. It's about awareness, not about betting against a system, but about refusing to bet everything on it. The math is already written. The signals are already flashing. The only unknown variable left is whether you're paying attention. Because when the next monetary chapter fully reveals itself, people won't ask what happened. They'll ask why they didn't listen when the market was already speaking.